All right, welcome to another episode of Biscayne Stories, where neighbors meet neighbors. Today we have Professor Timothy Burch. By now, most of us have heard about the Silicon Valley bank collapse. Professor Burch is here today to help us better understand the causes and consequences of this bank collapse. Aside from being a longtime Key Biscayne resident, Professor Burch is a full-time tenured associate professor of finance at the University of Miami and has taught finance to undergraduates, graduate students, and executives for over 25 years. He earned a PhD in finance at the University of Michigan, and prior to that worked as an actuarial analyst at a global pension consulting firm. Professor Burch's research spans a wide variety of topics in both corporate finance and investments, and he has published numerous articles in leading academic finance journals. Since joining the University of Miami in 1997, he has won multiple research and teaching awards, and his non-academic experience includes serving on the board of a mutual fund family, economic litigation support, business valuation, and providing personalized, objective help to individual investors seeking to better understand their investments and improve their relationship with their investment advisor. Professor Burch, how are you doing today? Thank you for joining us.
Good morning. So good morning, everybody out there. It's morning for us when we are recording this. It's good to be with you.
We're excited to learn more about what is going on and what happened with this bank collapse. I know you have a great presentation to show us today. So whenever you're ready.
Well, perhaps I'll let the audience be the judge of the great part, but I do have a presentation I can go through. This topic has been coming up a lot lately. Obviously, it's been in the news quite a bit. So I do have some slides that I threw together and thought I would run through those. You know, you can tell by my career choice, I'm a big believer in education, and I think a lot of times things can seem out there in the financial world very confusing and sort of baffling to a lot of people. And so hopefully after I go through this talk, you'll have a little bit better understanding of what happened with this particular bank and maybe some of the consequences as well. So let me go ahead and share my screen here. So let's just dive right in, and I'm gonna start with a slide that just shows you, just very simply, you know, how would I think about what happened? What's the primary cause of the collapse? And there it is up top. So the primary cause of the collapse was a failure for this bank to manage interest rate risk. Now I'm going to explain to you, what do I mean by that? You know, what is interest rate risk? So we'll see some detail as we go through the slides a bit further. But maybe just a short paragraph to describe this. I'll just read this with you. The risk that when an economy's interest rates change, you know, we know what's happened in the US over the past year or so. Interest rates have been rising very dramatically. So the risk that when an economy's interest rates change, the values of the assets and liabilities change to substantially different degrees. So that in our case here for this bank, so that the assets are far less than the liabilities. Okay, so we're going to even review here today a very simple balance sheet, make sure we understand what do we mean by assets, liabilities. But ultimately here, the concern is insolvency. You know, so investors started to become worried about insolvency. There were some major investors, some major depositors that had assets on deposit at this bank that became concerned about whether the bank was going to be remain solvent or not. And so we started to have a bank run, basically, and that's what touched all of this off. Okay, so before I get into the balance sheet,
can you explain insolvency exactly?
Sure. So what is solvency? So solvency is simply an inability to meet the obligations that the bank has. Okay, so you've got maybe depositors coming saying, well, I would like my money out of the bank. You could have the bank has liabilities that they have to pay. And so if they have insufficient assets in place and ultimately insufficient cash to be able to meet those demands, then they are insolvent.
Yeah.
All right. So before I get into all of that, just to take a little bit of a review here, what happened with the stock? I mean, when did this really all kick off? So this was Wednesday, March the 8th. And if you just looked at the trading in the stock, I mean, this is a publicly traded, or was a publicly traded bank. Right. So, it's got a stock price just like any other stock that we hear about out there. And you can see there not a lot of action happening in the stock, but there was news coming out on this particular day. Okay, so the bank comes out and they announce that they've got some deterioration in their performance. And there's one thing that's really important to banks, and that's net interest income. So let's think about what that is. So I think we all have the experience of knowing that when you put money into a bank, whether it's your checking account, a savings account, could even be a CD, for quite a long time, right? We've been earning very, very low interest rates from the bank on that type of investment that you and I might make. Putting our money into a bank, you can think about that as making an investment. Very low interest rates being paid. Okay, but of course the bank is not taking that cash that we're depositing and just sitting on it. They're lending it out and they're investing it. So those are the two things that they're doing with that money that people are putting on deposit. They are paying out interest to us, depositors, but they are earning interest on the money that we have put into the bank. Okay, so there's a spread there, the difference between the two. That is a major source of profits for these types of banks. Okay, and in fact, much more so over the past decade or so than in decades past. Well, this performance, this differential interest that the bank was earning started to deteriorate. So they started to have some poor performance. Okay, so we'll get to this a little bit later, but I just wanted to highlight, what are the investments on which the bank was earning interest? Well, primarily, they had invested in a lot of long-term treasury bonds. So, we have the United States Department of Treasury. We know we have a national debt. Treasury Department has to finance that debt. So they sell bonds. And the bank owned a lot of these bonds. They also owned a lot of bonds that were bundled together by some of the federal agencies that you may hear about, such as Fannie Mae, Freddie Mac. But basically, these are bonds as well. And these bonds are tied to people paying their mortgage payments. Okay. The simple thing to remember here is that the bank owned bonds. Okay. And we're going to review later in the notes here, how do bonds work and how are bonds valued, because really that's going to be crucial to understanding what happened to this bank. So the bank announces some deterioration in their performance, that they've had some losses, and they have taken some steps to sort of shore up the capital condition of the bank. Okay, so one of the things that they do is they sell a lot of these securities. Now, when they've got these securities or these assets, there are two different ways of classifying these. Some of them are classified in such a way that they're meant to be held to maturity. So notice I say long-term treasury bond here. So they can buy a bond that can last for 20, 30 years. And if they intend to hold that bond until it matures, that's a separate category of accounting on the firm's balance sheet, on the bank's balance sheet. Then there are these other assets that they've not designated in that fashion, and those are the ones that they sold. But they announced that they've taken a big loss on those, meaning they invested a certain amount of money in those bonds, but when they had to sell them very quickly to raise cash, they sold them at a loss. So they announced that they've had this big loss on this fire sale, if you're familiar with that term, of some of those assets that they owned. And they also announced, well, we're going to be issuing some new stock and preferred stock to try to bring some cash into the bank. So don't worry, everybody, everything's fine. We're going to recover from this. We'll be okay. So stock market closes, and investors start to ponder this, start to really take a look, dig into the financials of the bank, think about what's going on, and investors are not very happy, concerned, right? Is this bank going to survive or not? Are these steps that they've taken, are they going to solve the problem, or are things going to deteriorate further? So the next day, when the market opens up, some people think, well, stock price closes one day and it's going to start trading there at the next day at the same price, but that's not the case, right? First of all, there's a little bit of trading that can take place after the stock market closes, after market trading, and then when the market's about to open, those that are running the trading in the stock, they get some pre-market indications of maybe about where the stock price should be, and the stock opened the next day here, March 9th, you can see they're down about a third. Okay, so right at the start, you can see that overnight, people are the investors in the stock market, they're pretty concerned about this bank. Now, there's a pretty famous investor out there. You can Google this individual if you're not familiar with him, but Peter Thiel has a venture capital fund, and big financier, big investor out there. They have his fund. They have deposits at this bank, and they withdraw the deposits. And word gets out that they're doing that, and that they're also advising their clients, basically anybody, if you have money in this bank, take your money out. So that sets off a panic. People pay a lot of attention to this individual and his actions. And you've got other funds out there. They're also pulling money out. They're also advising their clients to pull money out. Okay, so a bank run begins. A bank run begins, right? Where everybody's trying to get their money out of the bank. Not everybody, but a lot of people are trying to get their money out of the bank at the same time. And I think most of us know that banks, they do not have the ability to just, if everybody shows up at once demanding all their capital out of the bank, banks don't have the ability to meet those demands, right? Because they only keep a portion of the overall deposits there available. Remember, they've taken those deposits and they've invested those in assets and made a lot of loans, as well, right? Now, we do have FDIC insurance, Federal Deposit Insurance Corporation. So why would there be a bank run? Well, the problem here is that is limited, right? So there's a limit on the insurance that the FDIC provides. And at a particular bank for a particular individual or entity, you can have little firms investing, depositing money in banks as well. But per account holder, it's $250,000. That's the limit. So think about this sort of backstop, if you will, by the federal government, by the FDIC. It's a limit. There's a limit there, $250,000. And of course, there are many different individuals and companies out there that have deposits at this bank that far exceed $250,000. So everybody's clamoring to get their money out, right? Here's what happens to the stock price on March 9th as all of this unfolds. So remember, the stock opened up the beginning of the day. Price there is about a third lower than it was the prior day's close. And the stock just plummets all day long, 60% from the prior day's close, and continues to fall even after that in this aftermarket trading that I described. Okay, so of course, this is garnering a lot of attention, and banks are regulated at two different levels. They are regulated at the state level. So banks have to have a license from the state. This bank was located in California, and California regulatory body there shuts down the bank. Okay, and you can see here FDIC takes over the bank. Says, well, this bank is insolvent, and they're aware of this bank run that's taking place. So they want to assure everybody. So they make this announcement that, well, even if you have more than $250,000 on deposit, we are going to take care of you, right? You're going to receive your money in full. Okay, so let's calm down, everybody, and let's not have this bank run. Let's try to get ahead of this and shut down this bank run. Okay, so this is pretty serious announcement, right? That the FDIC is going to exceed that deposit limit and just guarantee everybody's funds no matter what. And of course, what they're trying to do is they're trying to prevent spillovers of this into other banks. Okay, so this is a pretty large bank, but it's just one bank, and it wasn't like a top 5 or 6 bank in size. So perhaps if this bank fails completely and people lose some deposits, terrible for them, of course. But the concern was that, well, people are going to look at other banks that maybe are in similar positions, and they're going to start pulling their money out of those banks as well. And now we're going to have a big crisis in the banking sector, and then maybe ultimately the economy as well. So FDIC is trying to get ahead of this, tell everybody, relax, we're going to guarantee all of your deposits at the bank. Now, I want to focus on this particular statement that was included below the headline of this article that I've pasted in, the headline of this article, because this is going to be really key. And this is what I want to try to see if we can understand here by the time I finish my talk today. So even unrealized losses in investment portfolios can have negative effects on liquidity and present funding challenges. So think about you owning an investment, and you haven't sold the investment yet, right? You've got it sitting there in some account, but you can see that the value, the market value of that investment is falling dramatically. So that would be an unrealized loss for you. You're not realizing the loss until you actually sell the asset. But before you even sell the asset, you can see the value is much lower. Okay, so this is what we're talking about here. This bank, remember, it had invested in these bonds, and the value of these bonds had fallen dramatically, even though the bank had not sold them yet. So they only sold a small portion of the assets, the bonds that they owned, when they were running into that performance difficulty. They had a lot of other assets sitting there, but everybody is thinking about, well, what are the true value of those assets? And that the value had fallen quite a bit. Okay, so we're going to understand pretty soon here, why had the value of those assets fallen? Okay, so I'm going to review for you a balance sheet. Okay, so just a very simple example here. So hopefully this will be pretty straightforward. So let's say that you have $10 in cash and you'd like to open a lemonade stand. Okay, so $10 in cash maybe is not going to do it, and so you borrow some money from somebody else. Okay, so let's say we borrow $90. So let's take a look at what this looks like when we're going to set everything up. We have $100 in total, and let's say that we take 30 of the $100 and we buy our supplies. Okay, so let's put this all in a balance sheet format. Okay, so here's what this would look like. So we have assets go on the left-hand side of a balance sheet. And I'm going to show you the balance sheet of this bank in just a moment. So this is why we're doing this, right? Just kind of get our heads around what does the accounting look like? And you can think about a balance sheet as kind of like opening up the box that has all the financial information inside and taking a picture of it. So it's like a snapshot. What's the financial position here? So in our lemonade stand case here, assets, we can divide the assets into two major categories here, right? We've got some cash and we've got the supplies and the equipment. Okay, so remember, we put $30 into the supplies and equipment. We had $100 in total, so that means we have $70 in cash sitting there. Okay, now for our bank, we're going to see that the bank, we would have a category here of investments, these bonds that they own. So we'll see that in just a moment. So there's the left-hand side of the balance sheet. Now, we have some debt, right? We have some liabilities. So remember, we borrowed $90. So we're going to account for that on the right-hand side. So here's the debt. Maybe there'd be any number of other liabilities. In our case, no other liabilities. All right. So we have total debt or total liabilities of 90, and we have total assets of $100. Now, if you take the difference between those two, we call that the equity. In financial accounting for firms, we call that owner's equity. You could think about this as, what's the real value of what you own? If you were to sell this business to somebody else, how much would they give to you right now for this lemonade business? They should be giving you $10, right? Because although they would be acquiring $100 in assets, they're also going to be taking on that debt. They understand that this lemonade stand business owes $90. The difference between the two is 10. Okay, so this is a very important item that investors pay attention to, and regulators do as well. What does the equity look like on the balance sheet? You can also think about this like a net worth. So let's say that you want to calculate your net worth, right? So what is your net worth? Your net worth is going to be the value of what you own minus what you owe. That's your net worth. Okay. Ideally, we'd like to put all this on like a market value basis. Sometimes we can't do that when we're doing this kind of calculation for financial companies, or any companies really, but in financial accounting, a lot of these values, we would say they're book values, so they're like on paper values, but they're not necessarily current in terms of market values. As an example, let's take supplies and equipment here. We put this on the balance sheet at $30 because that's the cost of those supplies when we purchased those supplies. But let's say that something happens to change the value. Well, a financial accounting statement may or may not, it's complicated, but may or may not be updated to reflect the new value of those supplies. Okay. So the way that the balance sheet is reported out there may not be current in terms of reflecting market values, but stock market investors, they're trying to think about what the real values are. Okay, so let's think about our lemonade stand. We're going to go forward. Right now, we would say this business is worth $10. Somebody would pay $10 for this business, as we've discussed. But let's say that now we have a fire. Fire breaks out, and that fire damages the value of our assets. In particular, the $30 in the lemonade stand supplies and equipment falls to $15. Right? So we've got some deterioration of the balance sheet. So you see the adjustments that I've made. If we were to what's called mark to the market, the value of the assets, if we were to think about the supplies and equipment and mark this down from 30 to 15 to reflect the true value now of what we really have in terms of our supplies, obviously the total assets would change to 85. Okay, we still owe $90, right? So that stays the same. Well, the balance sheet has to balance. That's why it's called a balance sheet, right? So the liabilities plus the equity has to equal the value of the assets. Those are always going to be equal on a balance sheet. So what has to adjust here? Well, it's the owner's equity. And in this case, the owner's equity is actually going to be negative. And you could certainly have that happen on a balance sheet. Okay, so we would say that this business is basically insolvent now, right? Because the assets in place, $85 worth of assets, are not even enough here to pay off all of the debt. So this business has a big problem. How are we doing so far, Alejandro? Any questions come to mind?
Oh, you're doing very well.
All right.
Yeah. I like how we go into the complexity, but we break it down to also explain for those that need a refresher.
Yeah, and I know the audience out there, I mean, if you just look at who we have living on Key Biscayne, it runs the gambit. You know, we've got people that are extremely financially sophisticated,
Yeah.
and then we also have people that really have not had much exposure to understanding finance and accounting and so forth. So, you know, I don't want to assume much knowledge here as I'm going through this. So this is why I just wanted to have this little lemonade stand idea. Now, I don't know what it's like on Key Biscayne now. You know, my kids are grown up now, and I don't think they're going to open up a lemonade stand. You know, these days I hear stories about lemonade stands being shut down because, you know, they don't have the proper license and all these kinds of things. So, you know, I don't know if our police are going to look the other way or what's going to happen, but, you know, we can at least think a theory about having this little nice lemonade stand that we're running. All right. So what's the lesson that I want to get across here that we want to learn from this example? Well, when a business has assets that deteriorate in value, that can cause problems on the balance sheet, and that can accurately harm the perceptions about how much this business is worth and whether it's solvent or not, whether it's a viable business or not. And the thing to keep in mind again is that it gets complicated, but on the balance sheet on the asset side, sometimes these assets, they're not recorded at market value. Now, when I changed this to 15, I did that in recognition that we've had this fire and these assets are only worth $15 now, right? But depending on when these balance sheets are being calculated and what the rules are that apply for how the assets are recorded on the balance sheet, it's possible that this balance sheet would still show $30 just like we had on the prior page. So on paper, maybe everything looks fine, but of course, investors know, wait a second, this is wrong. This is not accurately reflecting what the true market values are. And we should actually be in this situation if we were to strike this balance sheet again or calculate this balance sheet again, showing all the current market values. All right, so I promised you that we would take a look at the balance sheet of SVB. This is, you know, balance sheets are not calculated and recorded on like a daily basis. This was the last quarter end. Any publicly traded company, they're definitely calculating and disclosing balance sheets and a lot of other financial statements as well on a quarterly basis. You know, the Securities and Exchange Commission requires that. Here's their balance sheet at the end of last year, December 31st, 2022. So let me highlight on the asset side, and see if I can remind us of what we talked about before. Two different ways of recording the assets on the balance sheet, and this is what the labeling actually said, actually looks like, right? Available for sale securities. So these are securities, again, what kind of securities? Well, primarily for this bank treasury bonds and these other bonds that were kind of connected to the real estate markets, but available for sale. So these are bonds that they do not necessarily intend to hold to maturity. And just like the labeling applies, they're ready to be converted into cash, no problem. And then they've got all these other bonds there that are labeled as held to maturity. So the plan is to hold those all the way to maturity. So, you know, if it's a 30-year bond, for example, the plan is they're just going to hold that bond all the way to maturity and they're not going to liquidate that bond. Okay, so this is what the balance sheet looked like. And here's sort of what happened to the balance sheet. Okay, so more recent striking of the balance sheet put those at about $22.8 billion. Okay, so think about this at the very beginning of March. If we, no pun intended, if we marched forward in time a little bit to March, and they struck this balance sheet again, it would have been about $22.8 billion. Those are the assets that they sold. So I mentioned earlier, when they started having some performance issues, they started selling assets to try to help cover those losses. So that's what they sold, and that's what they only sold for $1.8 billion less. So had earlier in the slides, right, that they took a $1.8 billion loss. Okay, so there you go. There's the $1.8 billion loss. Now, what about the rest of these? So, these big investors and also these big depositors like Peter Thiel, they're looking at this and they're thinking, how much are these bonds really worth? How much are these securities really worth? Okay, so the estimates were that maybe the market value, look, if they're having trouble and they're going to have to start selling these things after all, that maybe the market value is only about $76 billion. Okay, so we've got a big deterioration here on what the balance sheet should really look like, similar to what we had with the lemonade stand. And I haven't done all the calculations, to cross out the numbers and, recalculate what the owner's equity would look like and everything else. But if you just think about the differences in the values, the markdowns that we have here, we can see what would be happening here to equity. This would be going negative. So these big investors and stock market investors, big depositors are looking at this bank, thinking about what's the true value here. This bank's not in good shape at all. It's a mess. It's a mess. All right. So what I want to do now, I want to help us understand why did we have the value of these assets fall so dramatically? What happened there? What happened there? So my very first slide, after the title slide there, I mentioned that this bank did not manage interest rate risk properly. The reason that the value of these assets fell so dramatically has to do with what's happened to interest rates and the U.S. economy. Okay, so I want to take us through how this happens, and we can learn a little bit here about bond valuations. So just like I had this lemonade stand example, I'm gonna start with a very simple example, and then sort of build on that, so we can understand how bonds are valued and how the values can change based on interest rates in the economy. So here's a very simple bond. We would call this a zero coupon bond. I'll show you what coupons are in just a little bit. So this is just a very straightforward bond. It's a promise of $1,000 to be paid to you in 1 year. And the question would be, how much would you pay for that? Now, there's two ways you could think about coming up with a price. One is you just sort of think about it. It just sort of pops into your head that you have this maximum price that you're willing to pay. And you're not going to pay a penny more than that. Obviously, you're not going to pay $1,000 today because you should be earning some interest on this. You can do other things with your money. There's other ways that you can invest your money. You're worried about inflation, for sure. These days, that's a big concern. There's going to be some erosion in the purchasing power here. So if you tie up your money for a year, you want some return on that. Okay, and let's say that the price that you decide is the $9.25 that you see here. The way investors that are really trading and investing in these markets, the way they think about this, they think about a required rate of return. They want to come up with some kind of interest rate that they are demanding. And they're going to look at lots of different things. They're going to look at risk-free rates in the economy. This is really what we're going to focus on here today, big time. These risk-free rates in the economy, where do they come from? They come from trading in treasuries, trading in bonds that have been issued by the United States Treasury. They think about perhaps other things. It's lots of things that go into those rates, but they, investors are going to look at market-based interest rates out there in the economy. And let's say that you, as an investor, you decide, based on what you see out there with interest rates, that you're going to demand 8% return. Okay, so that implies the price you're going to be willing to pay for this bond today, or the value of this bond today, if you will, is the $9.25 that I'm showing you there. Okay, so we can sort of see the simple math there. What are we doing? We're taking the promised cash flow in the future, and we are dividing that by 1 plus the interest rate that we're demanding, dividing it by 1.08. Okay, and I've got a little note here that we can see how we could go forward with this, forward in time. This is kind of like going backwards in time. So valuation is all about thinking about the cash flows in the future that you're going to receive and going backwards in time and thinking about, well, how much do I value those today in today's dollars? Okay. But you can go in the other direction and we can see the consistency here. So if you were to take the 925.93 and you invest it for 1 year and you earn 8%, that would give you $1,000 at the end. Okay. So we can go back and forth in time. But valuation, what's the future cash flow? And we're going to bring it back in today's dollars based on some kind of interest rate that we are demanding here. Okay. And we call that discounting, would be the technical term of that. We're calculating what's called a present value based on a discount rate of 8%. But the 8%, again, it's a rate of return that we are demanding if we're going to invest in this particular asset. Okay, so step 2. Let's get a little more complicated now. So is that, first of all, any Alejandro, everybody's relying on you to ask questions. Is this okay so far?
Yes, so far so good.
Okay, so let's make this a little more complicated, and let's say that the $1,000 was going to be paid to you 2 years from today instead of 1 year from today. Okay, so the timeline, it would look like this. And if you're still demanding 8% per year, let's say 8% rate of return, here's where evaluation would look like. I put this piece in just for completeness. We wouldn't necessarily write that piece out because it's just a 0 there. But you can see what happens with the $1,000. Now we're not dividing by 1 plus the interest rate, but we're dividing by 1 plus the interest rate squared, because we have 2 years of interest at 8%. And of course, notice the value that you place on this is considerably lower than the value up top, because you're having to wait an extra year to receive your $1,000. So the value today now falls to $857. Okay, and let's notice how we could go forward, think about investing the $857. What would this look like going forward? Well, I invest that amount today, and if I earn 8% 2 years in a row, the calculation is I'm just going to multiply by 1 plus the interest rate twice. Okay, so this is compound interest. We keep multiplying by 1 plus the interest rate for every period of investment that we have. So if I invest the $857 today and I earn 8% for 2 years in a row, that gets me to the $1,000. All right. So is that okay? That little step up in difficulty here. We've got an additional year involved here.
Yeah. So basically, if the promise of 1,000, the longer it takes, the less.
Correct.
The less I invest initially, right?
The less you're willing to pay.
The less I'm willing to pay.
The value you're going to place on this. Absolutely
to get that 1,000. Okay.
Yeah. So if I tell you, Alejandro, I'm like, hey, how much money will you give me today if I give you $100 tomorrow? You would say to me, well, I'll give you $100. I'll give you $99.99 or something like this, right? As long as you trust me, as long as you think that there's no risk of default, that I will indeed make good on my promise. Okay. But if I tell you I'm going to give you $100 50 years from now, I mean, you're a young guy. You'll very likely be around 50 years from today. How much you're going to give me for that? A much lower amount, right? Because you're not going to get your $100 until 50 years from today. So this separation in time between when you're going to receive the money and the value you put on today is a very important feature here, without a doubt. And we can see that right on the slide, right? The value that we would pay today for $1,000 to be received a year from today is substantially more than $1,000, the value of $1,000 promised to us 2 years from today. Okay. All right. So I hopefully we're okay with this. Now, the great thing about a podcast, right, is that you can always go back and kind of play this again, or back up a little bit.
Yeah.
Right? But hopefully
Yeah.
everybody out there watching along is okay with this. Okay, now one thing, let me just point out a little bit about this 8%. One of the things that we would think about in determining this 8%, that investors would think about, is not only the time component, as we see amply demonstrated here on the slide, but also, is there risk? You know, is this $1,000 guaranteed or not? So when people think about bonds, you know, most bonds in which people invest, we think of as being pretty safe. You know, we think, well, boy, stocks, they're really risky. You know, oh, bonds, they're you know they're a lot safer. They're a lot less volatile, and that's certainly true uh, um, to a large extent, but it doesn't have to be the case. And there are two kinds of risk when we think about bonds. There are two kinds of risk, right? One is default risk. And this is what people will pretty readily understand. I think you would understand that if you buy a bond that's been issued by the United States Treasury, that promises you, let's say, $1,000 in 1 year, that's a little different than if you were to buy a bond from, you know, some local business that just opened up, some new restaurant on Key Biscayne, let's say, you know, and you're going to buy a bond from them and they're promising to pay you $1,000 in a year. You're going to view these two things a little bit differently, right? Because you're going to understand that business might fail. That particularly if it's a restaurant, it's a very difficult, competitive business, and so you would not want to pay as much for the same promised cash flow from the new restaurant as you would for the $1,000 being promised to be paid to you from the United States Treasury. Okay, you know, the thought is that the United States Treasury is not going to default because they can print money. We might worry about inflation and how much the money is worth, but we're not going to worry about default, right? So U.S. Treasury securities relative, or you know, Treasury bonds relative to other kinds of bonds out there, they're considered exceedingly safe, and that the default risk, the risk of default, is negligible. So there's not going to be much of a default risk premium loaded into this 8%. It's not going to be much of a factor. So people might view a Treasury bond and they say, well, this is as safe as it gets. You know, this is incredibly safe, backed by the United States government, United States Treasury. Well, there's another kind of risk that we want to think about with bonds, and that's the interest rate risk. And again, this is what we're trying to eventually focus on here a little bit. So bonds, even those issued by the United States Treasury, they can carry with them a lot of interest rate risk. So we're going to see what this interest rate risk is all about here in just a moment. Okay, just trying to preview where we're going here a little bit. All right, but back on this slide, to back up, we understand valuation now, I hope, particularly the one down here, how we would put this value of 857 and how traders in the bond markets would put a value on this. They would come up with some kind of rate of return they demand, in our case, 8%, come up with the 857. So let's continue with this example, but now I'm going to tweak this just to make it much more like an actual bond. Okay. Let's assume that the interest rate, this 8% that you demand, that it's built into the payments themselves. I'm going to change the payments on the timeline here to look like this: 80 and 1080. Okay, now that number of 8 that you see there, it's not a coincidence that it matches the 8% rate of return that we were demanding. Okay, so take a look at what the valuation looks like.
So the bond issue payments in the way to maturity.
That's correct.
Okay.
That's exactly correct. Okay, so think about and notice the price here is 1,000. Okay, man, that's not a coincidence. Okay, so we would say this is a coupon bond. Most bonds pay coupons. Okay, think about this little piece here. This final payment as two pieces, 80 and 1,000, right? So we have the 1,000 from before, but basically we have a series of coupon payments that this bond includes, 80 and 80, 80 and 80, okay? I'm making these coupons annual. In real life, it's a little more complicated because the coupons are paid every 6 months and the amount would be lower, but we're going to just assume annual coupons here just to simplify a little bit. So the bond is not only promising to pay you the $1,000 at the end, but it's also promising to pay you $80, twice in a row. Okay. So the math works out where the value of this is 1,000. And let's think about how this would work, right? What if you lent me $1,000? Okay, so you're going to lend me $1,000 today, and you want or you demand 8% per year. Okay, so that's the interest rate that you're demanding. Whoops, as I shake my setup here. All right, so let's think about, what do you owe me right away to feel like you everything's fair and square? Okay, you lent me $1,000. If I were to pay you back immediately, what's the balance on this loan, if you will, that we've engaged in? You would want your $1,000 back today immediately, right? But if I don't give you that, if I give you nothing today, because after all, you just lent me the $1,000 today, what do I owe you a year from today? Well, if you're going to earn your 8% and I want to pay you off in full a year from today, I would owe you 1080, right? I would owe you 1080. And I say to you, no, I'm not going to pay you 1080 1 year later. I'm only going to pay you 80. Okay, so now what do I owe you? Well, I owe you $1,000 because I paid you $80. You put the $80 in your pocket, and so in your sort of mental account that you have going here, 1 year into the future, after I pay you that $80, I owe you another 1,000. So another year goes by, and since we're carrying forward this balance that I owe you of 1,000, now the balance that I owe you is 1080. Okay, and I say, yeah, I'm going to pay you that in full. Well, that's the bond that we just talked about. 80 and 1080. These are the payments that I pay to you. And I think you would agree that the price that you paid, or the amount that you lent to me of 1,000, that seems fair, right? You would walk away from this and you say, well, I received what I expected. I demanded 8% per year as a rate of return, and that's what I received. I lent out $1,000. Here's the first 8% that I receive on that, just the interest only, $80. And then at the end, I get another bit of interest, plus I receive my $1,000 back. Okay, so everything is internally consistent here. Paying $1,000 today for this cash flow stream is perfectly consistent with this 8% return. Okay, so this is very much how bonds work. If bonds paid interest on, or these coupon payments on an annual basis, this is what things would look like. Okay, 80-80. All right, mentioned before, yeah, real life, they're paid every 6 months. Okay, so now let's get back to the bank. Now that hopefully we understand a little bit about bonds and bond valuation, let's think about one bond potentially that this bank might have purchased. Okay, and let's say that March 1st, 2022, I've highlighted 2022. So this was a year ago. This was a year before they had any problems. They go out and they buy a bond issued by the Treasury Department. Call this a 30-year Treasury bond. This is called the coupon rate. The Treasury Department will set this based on what the market is demanding at the time. And you can see the 2% translates into those coupon payments that you see there of $20. Again, I'm using annual coupons for simplicity. So So if you were to pay $1,000 today, 1 year later, if you're going to receive the interest only that you're demanding, you would want to receive $20, right? Because 2% of $1,000 is $20. Another year goes by, they pay you another $20, etc. And this continues all the way out until 30 years from today, when they give you that final coupon payment of $20 plus they return the $1,000 in principal. The $1,000 it did, it's also called the face value of the bond. But all right. So just imagine this bond that the Trade Department issues is promising this series of cash flows. And if investors out there are demanding a 2% rate of return, a prior example, we had 8%, but here, let's say it's 2%. This is what the valuation equation would look like. Okay, so every $20, it gets discounted back at 2% for the appropriate number of years. This $20 here is 3 years from today. Here's how we would calculate the value of that today. $20, and we divide it by 1 plus the interest rate that we're demanding here 3 times in a row. So that's 1.02 cubed, right? So we can take all of these cash flows, value them all together, sum everything up, sum the value of each individual payment, and the value gives us $1,000. Okay, Alejandro, okay?
Yep.
Building on what we've done before. All right.
Yep.
Now,
I like it. All
right. So
is this how you teach your classes?
I'm sorry?
Is this how you teach your classes?
Yeah, more or less.
I like it.
Depends on what we're doing. Okay, so where did this 2% come from? So the 2% it's what's being demanded back here, March 2022, from investors in these kinds of bonds. Okay. And so where does it come from? Well, I'm going to show you what interest rates in the economy look like in the US back at that time. So this is March 1st. March 1st out of a hat here with this example. Just backing up a year. These are interest rates in the economy, risk-free rates in the economy of different maturities. These are known as constant maturity rates, treasury rates. The graph you see here is known as the treasury yield curve. If you were to Google, treasury rates, right up top on your Google search, you would see a site that has a GOV at the end. And to the left of that, Treasury, this, that, the other. They publish this every day. The Treasury Department publishes this every day at the close of business. You'll probably see this up by like 5:00 p.m. on any trading day. This is communicating to everybody out there in the financial markets what risk-free rates look like in the U.S. economy. And it's important for you to know 2 things about these treasury rates here, these risk-free rates. Number one, these are market-based rates. You do not have a bean counter in Washington, D.C. somewhere saying, well, I'm going to decide that the 20-year rate, is 2%. That's not how it works, okay? Instead, what they're doing is they're looking at the prices that trading day of all of these different treasury securities, and they're doing a lot of complicated calculations. They have to do some interpolations and so forth to figure out what are market traders demanding right now for cash flows of particular maturities. What's the rate of interest that they're demanding? What's the rate of interest? And so they calculate this and they publish this every day. They're market-based rates. Okay, and we all know for many years, we had like a good decade or so following the financial crisis of 2008 of very, more than 10 years, right? Very, very low interest rates. We all knew it, we all observed it, we all experienced it. Exceedingly low interest rates in the U.S. economy. Here's what they actually look like. And rates vary by maturity. So here's what these different rates look like at that particular time. Now, the Federal Reserve, okay, we all hear about Federal Reserve meets and they change interest rates. You know, they hold interest rates the same, or lately they've been pushing them higher and so forth. The Federal Reserve, what they do is they try to affect these rates in two different ways. Number one, the rate that they actually set is an overnight borrowing and lending rate between member banks. Between, you know, every day banks have to meet their capital reserves requirements. Some banks will have an excess of capital. Some banks need some capital, and in an overnight market, they will borrow and lend from each other. And the Federal Reserve is telling these banks, when you are borrowing and lending with each other, here's the rate that we want you to use. Here's the interest rate that we want you to use. It's a very, very short-term rate. Okay, it's literally like a 1 day or an overnight rate of interest. That, yes, you know, it's being set. You know, Federal Reserve meets, Chairman Powell and the other governors there, they get together, they have a meeting. Unless it's an emergency, they have these meetings 8 times a year, and they set this overnight interest rate. So you could think about them setting the interest rate, you know, right around here, right? I mean, you know, whatever this kind of overnight is. What about the rest of the rates? Well, they can't set those directly, but they can certainly influence them. You know, that overnight rate, it's a benchmark rate. All the other participants in the financial markets, they look to that overnight rate. Short-term borrowing and lending is very much affected by that Fed funds rate, as it's known, this overnight rate that they set. So you know, you're not going to have a 1 day rate that the Fed sets look like this for risk-free rates, and a 1 week rate be up here. You know, we wouldn't see something like that, right? So, you know, the rate has to be somewhat reasonably close if it's very short term to what that overnight rate is. This is the way the financial markets are going to work this out. As you get longer in maturity, the rates increasingly become just purely market-based rates. They become less and less influenced by that overnight rate. You know, so these rates here, they kind of have more of a mind of their own, if you will. Traders in the markets for these treasury securities, buying and selling these treasuries back and forth with each other, and these are the rates that fall out of this. The Federal Reserve does influence, though, those rates, because the Federal Reserve is a big market participant in those treasury securities. You know, so as an example, here is our 30-year treasury bond. Okay, and the Federal Reserve itself, they've got this enormous balance sheet, and they actually buy or sell these treasury bonds in the open market, you know, with other traders. They're just another trader in the marketplace, but they're a big one. And so they also try to influence the rates by themselves, either buying or selling all of these treasury securities from other investors. Okay, and so those are called federal. They're open market operations. So that's another tool that the Federal Reserve has to try to influence rates in the economy. But the bottom line is this: I'm going into the weeds a little bit more than I probably should have there. These are risk-free rates in the economy, and I want you to notice the level of the rates here for longer term, right around 2%, right? So when I had this 2%, I didn't pull that out of thin air. Okay, I'm using that because it kind of makes sense back then with what risk-free rates in the economy looked like. You can see that for maturities of 20, you know, maybe 23 years and longer, the rates are just a little bit above 2%. Okay, and then you can see all of these rates, of course, are less than 2%, sometimes considerably so. But the rate that falls out of this for this bond is 2%. Why? Because this is a big cash flow, you know, this is a big cash flow. So we end up with this rate that looks closer to the longer term rates. And this is how the marketplace literally was valuing this kind of treasury bond at that time back in March 2022. Okay, so 2% doesn't come from out of the sky. It doesn't come from thin air. This is what these interest rates looked like back roughly a year ago, a little over a year ago. Okay, now this is the same bond that I had up before. This is exactly this, everything here. It's exactly the same thing that I had before. All right, but I'm calculating the value a little bit differently here. And I want you to notice that I end up with the same value. And what's the difference between number 1 and number 2 here? Well, the difference between the two, notice the denominator, notice all the interest rates. I've got a different interest rate, a unique interest rate for every single cash flow. Okay. Even out here, these are a little bit different. If I showed you more decimal places, they would be a little bit different. Okay. So where do these rates come from? Well, these are the rates that are straight off of this yield curve that I showed you here before. Okay. So if I were to open up a spreadsheet and actually show you, what is a 1-year rate? What's a 2-year rate? What's a 5-year rate? What's a 15-year rate, etc. And then every cash flow, depending on the maturity of the cash flow, here's the 3-year right here. Okay, so this 1.41% that's being used here, this is a 3-year risk-free rate of interest. So I mentioned before, interest rates have different levels based on their maturities. That's what the yield curve showed us. So the 2% is just like almost like a summary statistic, a summary interest rate. Underlying what's going on here, really the way traders, more sophisticated traders, are thinking about all this is the approach number 2 here. To think about what are all the cash flows, when do they occur, what's the appropriate risk-free rate to use to value each individual cash flow. Okay. So we end up with the same value there of $1,000. Okay, if I just showed you number 2 first to begin with, then I could say, well, there must be some kind of interest rate that if I use that for every cash flow, I end up with $1,000 also. And the answer there is 2%. Okay, so 2 different approaches, but they get us to the same place. The second approach more directly corresponds or translates to this yield curve that I've plotted here and I've shown you. Okay, right? The second approach more directly corresponds to this because we just pick off the interest rate based on the maturity of each individual cash flow when we are calculating our bond value. All right, so SPV, they buy this bond. So let's get to the heart of the matter now. Let's zoom in on what happened. So they buy this bond March 2022. They buy it for $1,000. They record it on the balance sheet at cost. Okay. They put it on the balance sheet at $1,000. So remember a while ago we were looking at the balance sheet. We're focused right here. These held to maturity securities, this bond that we've looked at would have been in there. Okay, they get to record this at cost on their balance sheet, and they get to continue to carry them at cost on their balance sheet. Okay, so maybe they bought a bond 10 years ago that was a 30-year bond, and they just get to continue to have it on their balance sheet at cost. Okay, so that 91.3, it's kind of a stale value, if you will. It's not reflecting what the true market value really is as everything changes in the economy. So March 2022.
What about the yearly payments?
Sorry?
What about the yearly payments?
Well, they're just recording the $1,000. The yearly payments, they're reflected in where this $1,000 comes from, right? Because we have included those in the value that we calculated for the bond.
Okay.
Okay. Now, if you're asking, well, what happens when they own this bond and they receive the $20 payments? yes, that gets accounted for a little bit. I mean, it's like cash flow
Okay.
that's coming in, and yeah. So absolutely, things get a little more complicated than that. Okay. But the thing I want us to focus on right now is that this particular bond, if they purchased this bond March 2022, they would have recorded it on their balance sheet at $1,000. Okay, so that's the keeping our eye on the prize here,
Yeah.
the main focus on. $1,000 goes on the balance sheet. That's the value of this asset that they own. Okay, now let's march forward in time and let me show you how interest rates change in the U.S. economy. The yield curve I'm showing you right now, March 2022, that is the same yield curve I showed you before. I've just changed the scale on the vertical axis here. Okay, so the scale goes up higher now, because here's what interest rates look like March 1st, 2023. So we all know interest rates have gone up in the U.S. economy. Here's what they are. This is relatively current. I mean, it's April 7th today, is it? This is about a month ago. This is the beginning of March 2023, what interest rates look like in the U.S. economy. Okay, so the Federal Reserve has been increasing this overnight rate dramatically. Investors out there trading, they see all the inflation that we've had. They're demanding higher rates of returns, in part to compensate for these levels of inflation and so forth. Interest rates, risk-free rates in the economy move up dramatically. Okay, so this is a very dramatic, what we'd say, shift in the yield curve. A very dramatic upward shift in the yield curve. Now, let's think about, go back to the simple example. Let's just focus on this one. It's a very, very simple calculation that we did. What happens, so Alejandro, I'm going to put you to the test. Instead of using 8% in the denominator, what happens if I now require 10%? I put 10% down there. What happens to the price, the value? Which direction does it go?
I would say it goes down.
It goes down. Okay.
It becomes more expensive.
So, 8 divided by 2 is 4, right? But 8 divided by 4, if I increase the denominator, that's only 2. So the 4 goes down to 2, right? If we increase the interest rate that we're using to do valuation, we increase that interest rate, or discount rate as it might be called, the value drops, the value lowers. Okay, so what happens to the value of bonds on the balance sheet if the yield curve changes like this? The value of bonds goes down dramatically, increasing that denominator. We're increasing that interest rate. Okay, so let's see just how dramatic this would be. Okay, let's say that we had no change in the yield curve whatsoever. Interest rates didn't change, and we would be sitting here in March 2023, and I just want to show you that now, as of today, our today here is March 1st, 2023. Now this 30-year bond becomes a 29-year bond, correct? 1 year has elapsed, and this bond has 29 years remaining to maturity. And if interest rates had not changed in the economy, and I performed the valuation, I would still have a value of $1,000. And so if I had $1,000 recorded on the balance sheet for this asset that I own, that this bank owns, $1,000 would be a fair value. It's updated, it's consistent with what the value is. Because if I were to sit down and map out all the cash flows that remain out to 29 years, and I do all the math, the value is still $1,000. But this is an incorrect assumption here, right? This is if there had not been any shift in treasury rates or in these risk-free rates in the economy. We know, in fact, there was a very dramatic shift higher. And as you just helped us all surmise, the value is going to drop. Okay, so I'm going to put in here the new interest rate that accurately reflects the new yield curve, this higher yield curve here. And here's what it looks like if I use if I use like a single summary statistic rate. So analogous to the 2%, it becomes 3.9%. Based on the movement higher in the yield curve, I could show you this with all the individual rates tied to each individual cash flow. We could do that, but the rate that is a single rate that we could use for everything, based on that new yield curve, that more recent yield curve, 3.9%. Okay, look at what happens to the value. Okay, on the balance sheet, reported at 1,000. So literally SVB, they're recording on their balance sheet, oh yeah, $1,000. Okay, because they've categorized this as a held to maturity bond. They're not planning to sell it, and so the balance sheet that they calculate still reflects 1,000. But what's the market value? What's the actual value? $669. Okay, so the stock market investors are thinking about the values of these bonds, and they're saying, whoa, holy smokes, this is not worth $1,000. This is worth nowhere near that. It's only worth $669. Okay, I mentioned to you Peter Thiel, big influential depositor. They take a look at this as his venture capital fund, and they say, wow, this is bad news. SVB Bank has announced these problems that they're having, and that brings all this extra scrutiny, and everybody starts taking a close look at SVB Bank, and they recognize that what they had recorded on their balance sheet, way up here, in the blue box there, the 91.3, that's way off, and it must be a lot lower. Okay, and you can see it was actually down there, 76 billion. Okay, so this is the interest rate risk manifested in a big problem for the bank, right? The bank owned all of these assets. A lot of them were long-term assets. Interest rates came up in the economy, and that caused the true value of the bonds that they owned on the asset side of the balance sheet to fall dramatically. And suddenly everybody like realizes this and hones in on this and responds to this. Price crashes in the stock market. People are pulling their money out. Oh my goodness, this bank is insolvent. They're not going to be able to climb out of this, and everything sets off from there. Okay, so I mentioned interest rate risk. What is interest rate risk here? We went back to the beginning. It's the risk that when interest rates change the economy, the values of the assets and liabilities change in very different ways. Think about our lemonade stand. We still owed $90, even though we had this fire to our supplies. We still owed $90. The liabilities didn't change, but wow, the value of our supplies changed, right? In this case, the value of the bonds that they owned fell dramatically. People recognize that, but the liabilities are still there. And for that matter, people are now coming to the bank big time saying, give me my cash, give me my deposit. I want my money out. I want my money out. Right. So suddenly they've got all these cash demands to meet, but they just don't have the market value and assets to ever dream of selling them and meeting all of the demand. They've become insolvent. Okay, so that's kind of if you're with me so far, then you've got it. You understand basically what happened to SVB Bank. Okay. Now want to return. Well, let me back up. So Alejandro, pausing here. Everybody's relying on you. No pressure.
No pressure. It makes sense.
I'm not going to ask any questions here. I'm just asking if you have any questions. All right.
So far,
all right. So good. Okay. So here's this joke I'll share with you. So, were there warning signs? So why did the old man fall down the well? Why did the old man fall down the well? And the answer to that is he could not see that well. Okay, so
I get it.
Could not see that well.
It's like a dad joke.
So this is what we call a dad jokes, a dad joke. I do have kids. They're older now, but they still like my dad jokes. They will laugh at them, but everybody's a good sport in my family. They put up with my dad jokes. Should we have been able to see this? I mean, this man could not see that well, and so he couldn't see the well, and he fell down the well. Were there warning signs? Were there warning signs? There were warning signs. There were plenty of warning signs here. Okay, so let me give you four. I think I have four warning signs. So number one, January 2019. So this goes back years ago. Federal Reserve issues a warning to this bank, to SVB, over its risk management systems. Okay, so let's remember there are two different kinds of risk with the assets that it owned. One, potentially they could own risky assets, risky bonds that we might have default. Now banks they're heavily regulated as to the kinds of assets that they can own. They can't go out there and own lots and lots of super high risk bonds or junk bonds, if you've heard about those. They need to own high quality assets. No one's going to argue that owning treasury securities is a problem there. I mean, they're considered the highest quality types of assets that you can have. But there's another kind of risk that we've explored today, and that's this interest rate risk. That just because the treasury security is not going to default doesn't mean that its value can't fluctuate wildly based on changes in interest rates in the economy. So that's this other kind of risk. Now, I've not sort of investigated very carefully exactly what the warning stated, what kind of risks are they talking about. But in general, this gives us a sense that the Federal Reserve was raising some red flags and questioning whether this bank was managing its overall risk well. Okay, and a year goes by, 2020, they say, listen, they're getting more scrutiny because they are growing. Okay, they had been a big player in tech startups and making more and more loans to businesses, attracting more and more deposits. They're growing, and the Federal Reserve is starting to really take a close look and saying, look, your risk management is just not adequate based on how important you're becoming in the U.S. economy. Now, here's something very interesting. April 2022, we are not too far into the period during which the Federal Reserve starts increasing rates dramatically in the U.S. economy. They start influencing these rates higher. Okay, many firms now, so I teach a course on risk management and insurance, and it's exceedingly common these days that firms will have a C-suite level officer that's in charge of risk management, chief risk officer. And this bank, between April 2022 and January 2023, they had no officer in place, vacant position. So who's keeping their eye on the ball here? Well, should have been the CEO of the bank in this case, along with the board of directors. Now, the board of directors of this bank, there was only one member of the board of directors that had any banking experience whatsoever. So if you sort of look into this a little bit, it's kind of a little bit of a head scratcher. I mean, it's not that, yes, you want some diversity of backgrounds and experiences on a board, but a lot of people are sort of questioning only one board member of the board of directors that has banking experience. So that in and of itself raised a little bit of a red flag, and they've got nobody in place really dedicated. CEO's got a lot of things to deal with, right? So does the board, but they don't have a chief risk officer. So that's a warning sign as well. And everybody should have seen the Fed's going to be raising rates. Federal Reserve does not just announce these rate changes without any warning whatsoever. Every time that they meet and potentially raise rates, they also issue statements signaling where they want to go, what they expect to do. And they had been sending strong signals, consistent signals all along. Inflation's still a problem. Primary way we fight inflation is to raise interest rates. And the Fed had been sending these very strong signals that they're going to be raising rates all during this time period. So, it's a bit of a head scratcher as to why the bank did not do a better job managing its risk. Okay, and then finally, and appreciate your patience out there. I hope some of you are still tuned in. We're almost done here. So some warning signs, yeah, we're there. And then just to maybe talk about some consequences. Some I can be extremely confident about, and others maybe a little bit more speculative, but I think are likely. So high confidence on this one. I mean, yes, these regional banks, these smaller banks and regional banks, definitely a lot more scrutiny by investors. There have been a few other banks that investors are big depositors and stock market investors are paying more attention to, and you can bet there's been some overtime hours put in by staff at the Federal Reserve and the FDIC, sort of looking, do we have some other banks that maybe have some similar issues going on that we need to be concerned about? And if you read out there in the press a little bit, you'll find that Jamie Dimon, CEO of Morgan Chase, JP Morgan, they're talking about they have been putting together some big banks to try to maybe infuse some capital in some of these smaller banks, trying to look out for the overall banking system. So there has been some volatility in the banking sector. There probably will be some more volatility going forward. There are some warning signs in the economy these days. One thing we haven't talked about, but a downward sloping yield curve like we've had, that is a negative forecast for where the economy is heading. We've got a lot of conflicting signals in the economy, right? I mean, unemployment is low right now, and there's some other aspects of the economy that are doing quite well, but there are these warning signs. Downward sloping yield curve, negative signal for the economy. We've had an uptick recently in defaults on consumer debt. So think about credit card loans, car loans, mortgages, small business loans. Defaults have upticked a little bit, and so there is some concern out there that we could potentially head into a recession, but probably not a crisis. I mean, maybe like a mild recession may be coming. So a lot of speculation about that. And so if we do get some more weakness in the economy going forward, that starts to play out over the next several months, this is where some of these smaller banks could really start having some trouble without some intervention. So my advice to people out there that are thinking about Key Biscayne, let's say we've got a lot of retirees here of all different sorts of means, right? If you've got money that is that's on deposit at a bank, do pay attention to that FDIC limit. It's $250,000 right now, and you are putting yourself at risk if you've got more than that deposited at any one particular bank. A lot of people are recognizing that, and we've had money flowing out of some of these banks into some of the bigger banks. Your JP, your Chase, Bank of America, so forth. So some of the capital has been moving from these smaller banks into the bigger banks. There's been capital flows into Treasury securities, kind of Treasury securities we've talked about, money market funds. is another place that some of this capital has been going. So investors are and depositors, in general, are starting to kind of pay attention a little bit, and I think recognize that, well, if we start having multiple bank failures, there's no guarantee that the FDIC is going to just back everything up and exceed the $250,000 limit. They did so with SVB, but they're not making any promises that they're going to do this with every bank going forward. So that's something I think to pay attention to, and just recognize you are always taking some risk if you've got more than the $250,000 limit. So, we hear these days a lot about ESG investing. So this is a strong trend out there. Some circles, it's a little controversial. Some people think, well, it's a bit of a fad. But what does ESG stand for? Well, investors taking a look at the company's environmental policies or the impact on the environment of their business, let's say, social responsibility, those kinds of issues. And the third in ESG, corporate governance. And, this one's been around for a long time, right? These two, investors paying a lot of attention to these, at least some investors, relatively new, but not this one. Been around for a long time, but I think this third one is going to receive some renewed emphasis now because of this SVB bank failure, because at the heart of it, it really was a failure in the corporate governance model of this bank. As I mentioned, they didn't have their eye on the ball with respect to managing their risk properly, this interest rate risk that we've talked about. So I think we're going to have some more emphasis on the third aspect here of ESG investing. Another thing I can be confident about, I've just already really talked through the next two. Depositors, they are moving, they have been moving money around a little bit. And, this is where you're putting some stress on these smaller and regional banks, right? So people start taking their money out, and these banks have to take some actions to keep their balance sheet in good shape. We saw SVB try to take some actions to keep their balance sheet in good shape as a result of some of their poor performance. Now, maybe we'll have some banks that it's not that they're performing badly in the way that CVB was, but if people start pulling their money out, they may have to take some corrective action there. So I think we can look to that a little bit and keep our eye on these smaller and regional banks to see how they're handling these changes in where people want to have their money on deposit. How are they managing that? Probably the FDIC is considering raising the limit of $250,000. Wasn't that long ago the limit was $100,000. 20 years ago, certainly it was $100,000. I can't remember when they changed it to $250,000, but I believe that was when the 2008 financial crisis came along. It was, in the aftermath of all of that, they believe that was the timing that they raised it to $250,000. Think about somebody that's retired. They don't have to be a particularly wealthy person, super wealthy person. What does it take to retire these days? It's generally going to take quite a bit more than $250,000 for sustaining like a nice, even just middle class lifestyle. So $250,000 is not very much, and I think the Federal Deposit Insurance Corporation should be a little bit worried that there are too many individuals out there that they're not diversifying across banks, that they've got more than $250,000 tied up in a particular bank on deposit at a particular bank. And so one thing we can do is to try to nudge depositors, I should say, to not do that, to not exceed the $250,000 cap. But of course, the FDIC could just change the limit there. So it would surprise me at all if a year from now, rather, that we see this limit exceeds 250. That's no longer 250. And then hopefully, I think the Federal Reserve is taking a close look at how they can better monitor this kind of risk that we've seen. Interest rates are not likely to reverse course quickly and come down. We're likely to see continued increases in interest rates. So, Federal Reserve needs to, I think, take a look. What happened here? How can we better monitor these banks and nudge these banks in the right direction in terms of how they manage this kind of interest rate risk? And there are techniques and tools to manage interest rate risk. Some of the material that we teach our undergraduates and master students in finance. Some of these techniques are not particularly complicated, but you have to be proactive about it, and you have to keep your eye on what's going on. And hopefully the Federal Reserve will start to nudge these banks a little more strongly to pay closer attention to this kind of risk. And that's really all that I have. And I hope that it's been helpful to some of you out there. I love helping people understand what's going on in the world of finance. This is 90% of 80%, I don't know, of what I do day to day. I do my research and I do my consulting from time to time, perhaps, but primarily I'm all about education. And I would say I really, really enjoy helping people have a better understanding of finances and investing and so forth. So this has been fun for me, and I hope it's been informative for you. And with that, I'll turn it back to you, Alejandro.
No, thank you. This definitely been educational and informative on the situation, because like we were talking during our break, is like, the news and social media and everything covers just a fraction of what's going on.
But I think sometimes people, just the broader point about taking the time to dig into something and try to understand it, I think a lot of people are intimidated. If they've not had any formal education in finance, they find it a bit bewildering, and sometimes people feel, I think, at mercy of people that are working in the field of finance. They feel a little bit intimidated, but ask those questions, right? If you should absolutely be able to have a conversation if you've got a financial advisor, financial planner, wealth management firm, what have you. You absolutely should try to ask for clarification, for some understanding. If you're concerned about what's happening with your investments, you should ask some questions. What are the risks that I face with the kind of investments that I have? Knowledge is power, and I just, one of the reasons that I went into academia to begin with, I can remember it like yesterday, writing up some analysis that I had done of stock market returns over the long term, because my mother was kind of nervous about this money that my family had invested in the stock market, right? And I really enjoyed helping her feel more at ease and a little more comfortable about what was going on. So that was like a turning point, really, in my life. That was really fun and really rewarding to help people better understand what's going on. So I really enjoy that, and I think that people can understand a lot more than they think. You just have to take the time to really dig into it, and ask questions, of people that can help you. And I think if you'll do that, you'll be able to make better decisions in how you manage your finances, and whatever small part I've been able to play with my students and helping to get them higher up the learning curve, that's just really rewarding to me. So thank you, Alejandro, for the opportunity to do what I like to do, but in a different format, a different venue than in the classroom there on campus. And thanks for having me on.
I appreciate it very much for joining us and breaking this down. And I have to agree with you. I mean, is this not my world? So I don't necessarily know the details. It's been a while since I've had a finance class, and I don't do it every day. I particularly work in government. I deal more with constituents and other types of projects. So I don't move around the bond or the world. So this has been educational. So I appreciate your time and thank you for coming on the show. Don't leave after we pause, but
Okay.
thank you again for joining us and breaking this down. We look forward to having you again and talk about whatever else the market throws at us in the future.
There'll always be something to talk about, I'm sure. Thanks again.